you see the cartoon?
For Louis and Kathie Kroot, 2005 was a bad year. The couple, who live in Lexington, Kentucky, found themselves in serious financial trouble.
We wound up with a large IRS bill when we moved some 401k money around. That was the biggest part.
The Kroots' troubles are the kind that many Americans face. Their financial problems put this former Navy medic and his wife, who volunteers at a local synagogue, in a desperate situation. Journalist Jason McClure interviewed the Kroots for a series about people who've fallen victim to companies accused of being predatory lenders.
The Kroots get themselves in a difficult situation in part by maybe making some poor decisions about taking money out of a retirement plan that triggered some big tax debts for them. They had adopted 2 special needs children in the 1990s after the death of one of their other children. These children, in spite of having insurance, ran up some very high medical bills.
One of our girls had some major emotional problems, and she was hospitalized 4 different times, and the co-pays for the hospitalization were outrageous. You know, when you're paying 25% of a $200,000 bill, that's a lot of money.
With nearly $100,000 in debts, the Kroots were distraught.
We were trying to figure out how we were going to pay these bills. We were just scratching our head.
So they went back to a company that they say helped them once before in the 1990s. It's known as U.S. Pension Funding, and it offers what are called pension buyouts, lump sums of cash in exchange for part of Lou's future pension payments. The Kroots called U.S. Pension Funding and in return received paperwork bearing one of the company's other names, Retired Military Financial Services. Marketing to members of the military is part of the company's business. Since Louis Kroot served in the Navy for 23 years, he has a pension that pays about $2,600 a month. That supplements his income from his current job at the local VA hospital. The man who runs U.S. Pension Funding, Stephen P. Covey, is himself retired military. On the company website, next to Covey's bio, is a stock photo of a man in military uniform, surrounded by what appears to be his family. The paperwork the Kroots received sounded promising. It said that if they took a buyout, quote, your debt load is not increased and is in fact decreased if you exchange the lump sum for payoff of current credit card or other debts. The Kroots signed up. Here's how the deal worked. Covey's company gave the Kroots roughly $91,000 to pay off their debts. In return, the Kroots agreed to give the company 95 months of Lou's pension.
We did not see any other way out.
We were desperate, and we really did not get the calculator out.
Had they gotten the calculator out, they would have seen that in exchange for that $91,000, in the end, they'd owe the company close to $250,000.
They needed money, and they felt like they needed money quickly, and so in all likelihood they didn't read the contract as carefully as they could.
The Kroots did what, according to many consumer advocates, millions of Americans do every day. They signed a contract without fully understanding what it said.
The company actually provided them with a couple of waivers at the end of their contract that said, we have been advised to contact an attorney to review this. We have been advised to contact a financial advisor to review this. But we've decided to waive those rights. And they signed that.
McClure dug through the 25 pages of the Kroots' contract. Among the things he found, the Kroots were required to purchase a life insurance policy to guarantee Covey's company its money in case Lou died prematurely. That policy alone cost them over $9,000 in addition to what they already owed. The Kroots also had to pay $132 every month in management fees. Over the course of their contract, that would cost them over $12,000. Tallying up all their costs, Jason McClure calculated that the Kroots were paying the equivalent of a 30% interest rate on the money they got from the company.
Until Jason did the math, I didn't realize it was at 30%, or pretty darn close to 30%. I had no idea. My immediate reaction was that this shouldn't happen to anybody.
McClure writes that a 30% interest rate would run afoul of many state laws against usury, the practice of loaning money at extremely high interest rates. But the company claims those laws don't apply because its products are not loans. They're, quote, buyouts. In the Kroot's contract, it states several times this is not a loan.
If something looks like a duck and walks like a duck, most people would say it's a duck. To have a product that is backed by something as solid as military pension payments and then guaranteed by life insurance payments, and to be getting an effective annual percentage rate of 30%, I think many people would view that as predatory and abusive.
There is a federal law that prohibits members of the military from, quote, assigning their pension payments to other parties. Several bankruptcy courts have examined U.S. pension funding's contracts and have differed about whether the contracts violate the law. Some courts have ruled in the company's favor, but at least 2 others have ruled against it. One judge wrote that the, quote, sale of future pension rights is specifically prohibited by federal law. Kathie's company says its business model is perfectly legal because it says its customers don't actually assign their pensions to the firm. Here's how it works. As required by his contract, Louis Kroot has to open a joint bank account that he shares with Kathie's company. Lou then has the government deposit his pension check into that account, and the company then takes the money out. Under this arrangement, the company argues that the Kroots haven't assigned the pension to anyone. Meanwhile, Jason McClure found a clause in the contract that said if the Kroots cause any interruption of those payments, the Kroots would owe another 2 years of pension and insurance payments to the company. That works out to a penalty of over $60,000. McClure says that the way this whole deal was packaged and written, it's not surprising to him that the Kroots were confused about its total cost.
The way this product is designed, I think there is an intentional effort to sort of hide what a bad deal it is for the consumer. And because this product is described in a different manner, is structured as a buyout as opposed to a strict bank loan, it makes it very difficult for the consumer to tell exactly how much they're paying and what sort of deal they're getting.
Last week, we asked Stephen Kathie for an on-camera interview. He said the timing wouldn't work out with his schedule. He did tell us via email that he plans on taking that interruption of payments penalty clause out of future contracts. He also disputed the calculation that the Kroots are effectively paying a 30% interest rate. He told us the rate in his contracts ranges from 13 to 19%. In an interview with print reporter Jason McClure, Kathie defended his company's products, saying it offers a valuable service to retired military families. As to the accusation that the company's effective interest rates and fees are predatory, Kathie said, "The position is, we're purchasing at a discounted lump sum future cash flow. We're not lenders. When you're not lenders, you're not dealing in potential usury areas."
Am I doing it right?
Yeah.
Nobody's holding a gun to my head. I got us into this situation. It isn't like the lenders, causes problem and force me to accept their help.
Lou and Kathie Kroot admit they made a rushed decision and didn't really examine the fine print of their contract.
And what we chose was not the best solution, okay? But it was still, my responsibility.
But Jason McClure says that if the costs of their contract had been clearer, or if the Kroots had understood what other options were available, things might look very different for them. For example, they could have used a debt consolidation firm and rolled all their bills into one manageable payment.
Had they merely consolidated all their debts into an 18% loan, which is about the average rate of their credit cards, it's not even a particularly good interest rate, they could have made the same monthly payment and they would have cleared their debt last year, but instead they're going to continue paying into 2013.
Kathie Kroot told McClure, quote, "We can't retire now.
Can you see it?
We've got at least another 10 to 15 years.
I'll tell you when they're grown up.
When they're grown up?